Welcome to the Deep Dive, your ultimate shortcut to understanding earnings calls.
Glad to be here.
Today, we're peeling back the layers on Loop Industries' Q1 fiscal 2026 corporate update.
A really interesting one this quarter.
Yeah, our mission, to unpack their key financial results, strategic developments, and, what's next for this company. They're right at the forefront of advanced recycling tech.
And the big question, as always, is about scaling that vision, right? Can they actually deliver these large-scale projects?
Exactly. So this deep dive aims to give you a clear picture of where things stand.
Okay, so starting with the results snapshot, what really jumped out to me straight away was the financial discipline.
Definitely. A clear focus on managing expenses, preserving cash. You really saw it in the operating expenses.
Right, the cash operating expenses were $2.6 million for the quarter.
Which is a huge drop, isn't it? Like $2.2 million less than the same time last year?
Yeah, 46%. That's significant belt tightening. Shows they're serious about conserving cash as they gear up for these big builds.
And that discipline is crucial because even with lower expenses, they still used cash.
They did. Cash used in operating activities was $3.1 million. But importantly, that included about $0.8 million in working capital outflows.
Okay, and they explained that.
Yeah, they said it was mostly timing on certain payments. Stuff they expect will actually benefit them later in the fiscal year. So think of it more like a temporary outflow, not a structural cash burn issue.
Got it. So where did that leave them in terms of cash on hand?
They ended the quarter with $12.3 million in available liquidity.
And the big goal now, financially speaking?
Well, the stated objective is pretty clear. Secure enough financing to cover their part, their equity contribution for the India facility.
And cover operating cash flow until that plant actually starts up.
Exactly. And they're looking at, government funding, those engineering revenues we'll talk about, and raising new capital to fill that gap.
Which leads us nicely into the strategic progress on the manufacturing facilities themselves. This is really the core of the story, isn't it?
Absolutely. It's where the rubber meets the road. Can they move from pilot scale to commercial reality? And we saw some concrete steps this quarter, particularly in India and Europe.
So let's start with India. Daniels Al-Amunita, the CEO, talked about steady progress towards groundbreaking for that first infinite loop facility.
Yeah, and he stressed the partnership aspect, working with excellent local joint venture partners who are, quote, fully aligned.
That alignment piece is huge in JVs, makes such a difference.
It really does. De-risks things considerably. And that seems to be helping with the offtake discussions too.
Right. The talks with potential customers, they said those are progressing well with big global brands in apparel and consumer goods.
Let's dig into that a bit. For apparel, it's about this textile to textile solution Loop offers.
Recycling old clothes basically into new polyester fiber.
Exactly. Which is a massive need for the apparel industry trying to get more sustainable.
Right.
It's positioned as way better than traditional mechanical recycling.
Which they called the way of the past, right? Because it mostly just uses old water bottles, not textile waste.
Right. And Loop's tech apparently removes all the color, the dyes, impurities, giving you virgin quality polyester fiber. That's the key claim.
Virgin quality. That term keeps coming up. Why is it so important for these brands?
Well, think about it. If you're a big clothing brand, you need that recycled fiber to perform exactly like new stuff. Same look, same feel, takes dye the same way.
Consistency.
Total consistency. Loop says their tech delivers that, letting brands use recycled content without compromising the product. And India, with its massive textile industry, is just swimming in the kind of waste polyester feedstock they need.
Okay, so that's apparel. What about the CPG side, consumer packaged goods?
Similar story, different material. European beverage brands especially need high-quality recycled PET for bottles.
And the current supply isn't cutting it.
Apparently not. Reports are the quality of mechanically recycled PET is actually getting worse, which is a problem for packaging, quality, brand image.
So Loop comes in saying they can take almost any PE race bottles, carpets, textiles, whatever,
and turn it into virgin quality PE resin, regardless of how messy the input is. That promise of high quality from 100% recycled content, that's the pitch.
That really does sound like a potential game changer. But what are the hurdles, making it work economically at scale?
Scale and capital are always the hurdles. Which brings us back to India's cost structure. That seems to be Loop's ace in the hole.
Lower costs there mean they can sell this high-quality PET and fiber competitively.
Exactly. Sell it at good prices, still make attractive returns for the JV, and generate cash to fund future expansion. It's meant to be a self-fueling cycle.
And they put a firm number on the India project costs, the CapEx.
They did, $176 million. And crucially, that number was confirmed by TA, the engineering firm that did the detailed FEED study.
So that's the all-in cost. Polymerization unit, land, financing through startup.
Yep, includes all of that.
But the underlying tech cost is lower.
That's where it gets really interesting. Strip out the polymerization, land, financing, and the installed cost for just Loop's core tech is $95 million,
Okay.
which they claim is the lowest in the industry.
Yeah.
It works out to just $0.61 per pound of annual capacity.
61 cents a pound.
Yeah.
Wow.
Even with the polymerization unit included, it was only 75 cents per pound. That low capital intensity is key to their whole global deployment idea.
Makes sense. And they're zeroing in on a site.
Down to 2 locations in Gujarat, industrial zones. Final decision coming very shortly.
And the permitting is easier there.
Apparently, it comes with the land purchase in these zones, so they can start construction quickly once the deal is done.
Utilities, power.
All included in the CapEx. They'll provide everything needed on site. It's actually not a huge power draw, less than 5 megawatts. And the main energy for steam, 100% biomass, rice husk.
So ticking the environmental box too.
Seems like it. And the JV structure, how does Loop benefit directly?
Well, they own 50% of the JV's returns, obviously, but they also get a 5% licensing fee on the tech and sales, plus engineering fees.
So multiple income streams from the project.
Right. They've already signed a $1.5 million engineering contract with the Indian JV to get started on detailed engineering and construction support. So revenue flowing already.
Okay, so India is moving fast. What about Europe?
Also advancing. They're supporting their European partner, Daniels, and its new CEO, who's focused on speeding things up. Site selection in Western Europe is the top priority right now.
And this is where that modular strategy comes in, right?
Exactly. This is pretty cool. They plan to engineer it modularly, build the modules in India, where costs are lower.
And then ship them globally for assembly on site, like giant Lego bricks.
Kind of, yeah. And they reckon this could slash CapEx by potentially 50% compared to building everything traditionally on site, a stick build.
50%. That's massive.
Yeah.
That would make deploying this tech in higher cost regions much more feasible.
Totally. It positions them to deliver quality product at competitive prices almost anywhere.
And Loop gets more than just its share of the project profits in Europe.
Yeah, besides the JV economics, they expect to generate revenue from actually providing these modular solutions, plus engineering services. And there are 2 milestone payments tied to that first European facility.
Diversified revenues again. Smart.
Okay, so facilities are progressing, but you need customers. How are those offtake agreements shaping up?
Critically important piece. Discussions are moving forward, especially now that the India CapEx is confirmed. That lets them talk concrete numbers and profitability.
And they're aiming for longer deals.
Yeah, typically 3 to 5 years, not just spot market stuff, which, takes longer to get signed off by senior management at these big brands, especially now.
But price isn't the sticking point.
Apparently not in India, thanks to the low costs. What's really key for getting financing, though, are the take or pay clauses.
Meaning the customer has to pay even if they don't take the product.
Pretty much. There are penalties like 40% to 100% of the contract value if they just walk away from the volume. That gives banks confidence.
Makes the whole thing bankable.
Exactly. The goal is to get a decent chunk of the capacity pre-sold before startup to get better terms on the debt.
Interesting difference in contract types, too. Fixed price in India.
Yeah, it gives Indian customers cost certainty, which is a big plus there, given feedstock availability. But in Europe, it might be more of a cost-plus model because things like energy prices can vary more.
And the contracts are direct, Loop to the brand.
Correct. Loop signs with the CPG or apparel company, and then it has a back-to-back deal with the JV. Keeps it cleaner for the customer.
Okay, makes sense. How's the actual debt financing going?
The Indian JV hired KPMG to syndicate the debt. That's pretty standard in India, apparently.
So KPMG rounds up the lenders.
Essentially, yes. They're already pitching the project details to Indian banks and also to international groups like Canada's Export Development Bank, EDC.
And those signed customer contracts are key for those presentations.
Absolutely crucial. Proves the demand and the economics to the banks.
Timeline again, India operational by end of 2027.
That's the target. Based on an 18-month construction starting, say, fall 2025, plus about 6 months for startup and commissioning. So roughly 24 months total.
What if there are delays? Any penalties for Loop? Can customers walk away?
Good question. They stated explicitly, No financial penalties on Loop if construction delays affect delivery. And customers can't just cancel their agreements if Loop misses milestones.
That seems quite favorable to Loop.
It does. They also clarified that old issue with Coke and Pepsi back in, 2018. That was because Loop didn't build a specific facility they'd planned, not because Coke and Pepsi pulled out of existing contracts for facilities being built. Important difference.
Okay, clarity there is good. Now, Loop's own cash contribution for India, how much do they need to put in?
Total equity needed from Loop is $25 million.
Okay, how do they get there?
Well, about $5 million is coming from reusing some polymerization equipment they already bought for a previous project.
Repurposing assets. Smart.
Then a portion is committed from a government entity in Quebec.
So what's the remaining gap?
About $15 million. And they're looking at several options to fill that, including potential revenue from the engineering and modular work for the European project.
And they need that $15 million by when?
By fall 2025, basically when groundbreaking is expected. So the clock is ticking, but they seem to have a plan.
Any worries about getting key equipment on time, long lead items?
They said no issues there. The main reactors needed for polymerization. They already have them in stock.
Oh, okay. That's a big one.
Yeah, huge de-risking factor. Other chemical plant components apparently have about an 8-month lead time, which fits well within that 2027 startup window.
So the immediate projects seem on track. What about the bigger picture? Licensing, future growth?
Well, confirming that India CapEx and developing the modular approach really helps. It lowers the cost barrier for new projects significantly.
Makes it easier to build in places like North America or other parts of Asia.
Exactly. Places where building costs are traditionally much higher. And their European partner, this Suction Group, is apparently very keen on building multiple modular plants via their private equity arm.
So the pipeline could grow quickly if this model works.
That's the idea. They're looking at other global opportunities too. And they're already planning India too.
Another facility on the same site in India.
Yeah, 50% bigger capacity, so 100,000 tons.
Yeah.
Aiming to kick that off about a year after the first one is running, really leveraging that low-cost base. It's a classic land and expand play.
Okay, stepping back then, what's the key takeaway for investors, for you listening?
I think it starts with capital efficiency. That low CapEx per pound, especially at $D.61 for the core tech, plus the modular build strategy. That's a potential major advantage over competitors.
Allows faster, cheaper, global rollout.
Right, and the ability to scale capacity while bringing costs down further, that's powerful.
Then there's market demand. You've got brands desperate for high-quality recycled content, especially as mechanical recycling quality drops.
Loop's virgin quality output meets that need. And offering fixed price deals in India gives customers stability. That's a strong value proposition. Security of supply is huge right now.
And execution risk. They seem to be tackling that systematically.
Yeah, the progress on land, getting KPMG for debt syndication, those take or pay contracts. It shows a structured approach to de-risking these big projects.
Even with that $15 million funding gap still needing closure.
Right, they acknowledge it and are working on it. And clarifying past issues helps build confidence too. Shows they've learned, perhaps.
Finally, those multiple revenue streams are key. It's not just about the profit share from the JVs.
No, the licensing fees, the engineering services, selling the modular solutions. That all adds up and could create significant value as they expand globally.
Yeah.
It's not a one-trick pony, as you said earlier.
All right, now let's shift gears slightly. Time for our This Is Not Financial Advice segment.
The usual disclaimer applies.
Absolutely. This is purely for informational and entertainment purposes. We are not financial advisors. This is not financial advice. Investing has risks. Please do your own research.
Okay, disclaimer done. So the trade idea. Consider a long position in Loop Industries, but not just as a bet on them building recycling plants.
Oh, what's the angle?
Think of it as a strategic bet on a future acquisition by a huge global CPG or apparel company.
Interesting. Why?
Because the need for real circular solutions is becoming critical for these giants. Loop's economics, that $1.61 per pound tech cost, the 50% modular savings, the ability to guarantee virgin quality from diverse waste with fixed price take-or-pay deals?
Becomes strategically irresistible.
Potentially, yes. Imagine a massive CPG company under pressure to hit sustainability goals and secure future recycled feedstock. Buying Loop outright could be seen as the fastest way to internalize that capability.
Lock in the supply chain advantage, deploy the modular tech globally across their own operations, basically buying their ESG solution.
Exactly. And that strategic imperative, driven by brand image, ESG targets, supply security, It could justify an acquisition price way beyond typical chemical company multiples. Even before India is fully ramped up, it's a bet on strategic necessity.
A provocative idea. Okay, let's recap the quarter then.
So, Loop Industries, Q1 fiscal 2026, showed strong expense control, solid progress on the big India and Europe manufacturing projects.
That innovative modular strategy looks key, potentially slashing costs and speeding up global deployment. Competitive CapEx, high-quality output, they're carving out a unique spot.
And a disciplined approach to getting the financing and locking in customers seems evident. It points towards a clearer path for growth, assuming they execute.
So, as you digest all this, the bigger question to mull over might be, how could technologies like Loops fundamentally reshape global supply chains?
Yeah, how will they accelerate that push towards a truly circular economy across different industries? It's more than just recycling. It could change how things are made.
Definitely food for thought. That wraps up this deep dive. Thanks for tuning in to The Deep Dive.